Welcome to Alpha Recap. I'm glad you joined us after the close. Today we're unpacking a market that closed with clear winners and losers, driven by big bets on AI, a pickup in renewables, and some painful flows in crypto and recycling. As always, if you have questions, you can reach us at stockalpha.ai and use our Q&A feature.
Thanks for having me. It was a busy session. We saw structural themes show through, but there were some headline-driven shocks too.
Let's start with the big picture. The tape skewed toward megatrend beneficiaries. Technology, industrials, and parts of the energy complex outperformed. That upside came from fresh M&A, funding and deployment signals tied to AI, onshoring and decarbonization. Walk me through why tech led the way.
Sure, the story in tech was really about continued capital allocation into compute and AI infrastructure. One headline that stood out was IONQ's announced deal tied to Skywater for about $1.8 billion. Combine that with large funding rounds, including a major Chinese AI startup, and you get momentum. Investors treated it as proof that the AI investment cycle was still real.
And Moody's number was floated again today, about $3 trillion in data center spending by 2030. That's a massive backstop for suppliers across sectors.
Exactly. That estimate means this isn't just a software story. It ripples into industrials, materials, utilities, and real estate. Everything from server racks and cooling systems to transmission upgrades and data center land.
Industrials were another outperformer. We had some big manufacturing headlines. Anduril announced a $1 billion expansion, and General Motors pledged to onshore Buick and Vision production by 2028. How did that read through the industrial complex?
Those moves reinforced a reshoring and defense modernization narrative, with Anduril expanding and GM onshoring. Demand for robotics, specialty machining, semiconductor test equipment, and logistics should pick up. That's why we saw strength in industrial suppliers and automation names.
Energy also outperformed, but not in the fossil sense. Clean energy deployments and policy pushes were the catalysts. Tell listeners what stood out here.
Europe pledged about 100 gigawatts of cross-border wind capacity, Turkey brought a major solar plus storage project online, and China launched lithium futures. Those items together signaled faster renewables deployment and clearer price discovery for battery materials. Developers, turbine makers, and battery supply chains all got a bump.
So that was the upside. On the other side, we had sharper flows and headline risk. Crypto really felt it. Global crypto ETPs recorded about $1.7 billion of outflows, Bitcoin slipped below $90,000, and a SwapNet incident drained about $16.8 million. How should investors interpret that?
It was a reminder that crypto remains flow and custody dependent. When you see large ETP outflows and security incidents, liquidity dries up fast. That's a warning sign for concentrated, uninsured, or lightly regulated exposures. The market treated it as a high beta pocket that can reprice abruptly.
Materials and recycling names also underperformed. A UK recycler went bankrupt, and Winter Storm Fern disrupted scrap flows, leaving nearly 1 million customers offline. What were the downstream implications?
Bankruptcies in recycling create supply shocks for manufacturers depending on recycled inputs. When scrap flows get interrupted by storms or insolvency, input costs and delivery timing become unpredictable. That drove dispersion in materials in some processors that run on thin margins and tight credit.
Consumer and retail also showed stress, with vendor bankruptcies like Saks Global creating vendor concentration risk. That's showing up in financing and receivables pressure, right?
Right. Vendor bankruptcies mean late payments, inventory buildups, and disrupted supply chains for retailers and branded consumer companies. Investors reacted by repricing credit risk in that corner of the market.
Let's unpack the cross-sector themes. First, AI and data center capex as connective tissue. How do investors play that beyond just buying big tech names?
Look beyond the headline names. Suppliers of servers and cooling, specialty metals and chemicals used in data center builds, industrial equipment makers, utilities planning grid upgrades, and real estate vehicles with data center exposure all stand to benefit. For example, industrial firms that make automation for data center construction could see durable revenue growth tied to that roughly $3 trillion spend through 2030.
Second theme, renewables and electrification. Policy pledges and new market instruments are tightening links across energy, materials, and industrials. How should investors position?
Favor developers with secured project pipelines, vertically integrated materials companies that handle battery chemistry, and producers with hard-to-replicate assets and industrial suppliers making turbines, inverters, and storage equipment. With China launching lithium futures, price discovery will improve over time, but timing and staging are important.
Third, liquidity and regulatory risk. Aside from crypto, consumer vendor stress and recycling insolvencies are amplifying dispersion. Any practical rules of thumb?
De-risk concentrated crypto allocations unless you have custody protections. Prefer custodial models with real balance sheet strength. In consumer, stress test vendor concentration and tighten your receivables assumptions. In recycling and materials, favor companies with diversified feedstocks and long-term offtake contracts or certification that reduces counterparty risk.
Fourth, policy uncertainty. Markets priced about a 78% probability of a U.S. government shutdown by January 31st. How did that show up?
That kind of probability elevated headline volatility. Sectors that depend on federal spending or approvals, defense, some healthcare reimbursements, infrastructure projects, saw risk premia widen. Investors started trimming exposure that relied on timely government action.
Okay, let's get tactical. You mentioned targets earlier. If you were building a watch list coming out of today, what would be your three priority buckets?
1. AI and data center beneficiaries, but selective. Look for infrastructure providers, software vendors with recurring revenue, and industrial suppliers tied to data center builds. 2. Renewable infrastructure and battery supply chain names with secured offtakes or vertically integrated assets. 3. Balance sheet strong materials and recycling names, those with diversified feedstocks, certification, and long-term contracts.
For people holding crypto or high beta consumer names, what were your risk management takeaways?
If you held concentrated crypto positions without custody protections, reduce exposure or move to regulated custodial products. If you owned consumer names exposed to vendor solvency risk, re-underwrite vendor concentration and tighten stop losses or use options to hedge. And across both, increase cash cushions for event risk.
We also recommended staging exposure in materials as lithium price discovery develops. How should listeners size that?
Consider phased entries. Lithium and battery markets can be volatile as futures and spot prices adjust to new market signals. Start smaller, monitor contract wins and project pipelines, and increase exposure as you see confirmed order flows or longer-term offtake agreements.
There were a lot of notable moves today. Quick reminder to listeners, IONQ's Skywater deal was about $1.8 billion, Synthesia raised about $200 million, Orbital took in about $60 million, Anduril announced a $1 billion expansion, and GM committed to onshoring Buick Envision by 2028. Any color on the implications of the IONQ deal specifically?
The IONQ deal signaled that frontier compute and related foundry capacity were getting real capital commitments. That raises the stakes for suppliers. Think cryogenics, specialty materials, and software integration partners. It tells the market that companies are preparing supply chains for higher volumes and tighter integration.
On renewables, we noted Europe's 100-gigawatt cross-border wind pledge, Turkey's solar plus storage milestone, and China's lithium futures. How quickly could that translate into order books for equipment makers?
Some of it is near-term. Projects that move from permitting to construction drive immediate demand for turbines and inverters. Other parts, like transmission upgrades and large battery deployments, are multi-year. But policy pledges and futures markets accelerate procurement decisions, so you could see incremental order flow within quarters for companies with secured project pipelines.
Let's cover the downside scenarios. What can change this narrative quickly?
A sudden risk-off caused by macro news, a surprise Fed move, or geopolitical escalation could slam tech and cyclicals. A confirmed government shutdown would hurt finance, defense contract flow, and certain healthcare reimbursements. A large systemic crypto custody failure or tougher regulatory mandates could accelerate outflows. Conversely, positive policy action supporting grid upgrades or infrastructure could amplify the winners.
Before we close, give listeners 3 clear takeaways they can act on tonight.
1. Tilt portfolios towards selective AI and data center beneficiaries, but pick companies with diversified revenue and strong governance. 2. Build a core allocation to renewable infrastructure and vertically integrated battery materials staged as price discovery unfolds. 3. De-risk high beta pockets, tighten exposure in crypto and vendor-concentrated consumer positions, and favor balance sheet strength in materials and recycling.
Great. Quick housekeeping. We recorded this after the close, so everything we covered was historical market action. If you want the short list, own the long-duration themes being funded today, AI and renewables, and avoid getting caught undercapitalized in headline-sensitive spots like crypto and vulnerable vendors.
And remember that near-term weather or policy headlines can create buying opportunities. Storm Fern and the shutdown odds created volatility that some investors used to add to high-quality industrial and utility names with solid backlogs and regulated cash flows.
That wraps today's recap. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening, and we'll see you next time.